Recording transactions. To record a transaction, first the accountant will record it in the journal. A transaction is any event that affects the accounting equation. So this could include purchasing supplies, paying for expenses, the owner contributing assets. To record a transaction, step 1, you record it in the journal. So you debit something and you credit something, and the amount must be the same. Step 2 is you copy or post that journal into the ledger, and the ledger contains all the different T accounts for every asset, liability and equity, and you copy all the amounts into the appropriate T account. And then step 3, we prepare a trial balance. This contains all the account names in a list with the amount in the debit or the credit column, and so on. And there's a few more steps after this, but we'll talk about them later on. What I want to focus on today is recording transactions in the journal. How do we do this? You really need to know 3 things to record transactions in the journal. When you read the transaction, first you need to know, is there an asset, is there a liability, is there equity, and which specific type of asset, liability or equity. There must be 2 things because of the double entry accounting. Is there an asset, is there a liability, or is there an equity? I think this is the hard part, and this is what takes practice. Then you need to identify, is that asset or liability or equity increasing or decreasing? And then you apply the rules of debit and credit. What are the rules of debit and credit? Let's take a look. Assets, expenses, and dividends all follow the same rule. The increase is on the debit side and the decrease is on the credit side. Liabilities, equity, and revenues all have the same rule, which is the opposite. The credit is the increase and the debit is the decrease. I find it helpful to always have those rules in front of me when I'm recording transactions. If you're not sure about these rules, you can check out my other screencast. So I've got an example here of 10 transactions, and we're going to look at how to record a journal entry. So we're going to go through the 3 steps. First, identify, are there any assets or liabilities or equity? Are they increased or are they decreased? And then we're also going to look at which one is the debit, which one is the credit. And I've put the rules here of debit and credit for us to look at. I've got assets, expenses and dividends. The debit is the increase or the plus. Credit is the decrease. Liability, equity and revenue. The credit is the increase. It's the opposite. Let's take a look. We've got Circle Films issues 3,000 ordinary shares to investors for $5 each. So first of all, ordinary shares is part of equity. So that's equity increasing. And this is just a definition that you need to know, that issuing shares is recorded as contributed capital or contributed equity. When a company issues shares, they receive cash in exchange for selling those shares. So cash is increasing. So I've identified that there's cash, which is an asset, and there's equity. Both of them are increasing. So let's take a look at the rules. Here is an asset, and to increase an asset is a debit. So that's going to be my debit. Here is equity. To increase equity is a credit. So that's going to be a credit. There should be 1 debit and 1 credit. Here is the format for a journal entry. First you put the date or the transaction number. Then you put the accounts. The debit goes first. Underneath that you write the credit. So I'm going to write cash first, and I put the amount in the debit column. On the next row, I'm going to put the credit, contributed capital, and put the amount in the debit column. There should be one debit, there should be one credit. The debit goes first, the credit underneath. The amounts should be equal. Circle Films purchases 2 video cameras, which is equipment, and memory cards and supplies for $1,000. If you're purchasing equipment, that means your equipment is increasing. If you're purchasing supplies, that means your supplies are increasing. Both of these are assets because they're things that the business can use. Now, when you buy something, you normally pay for it. So that means we've got cash decreasing, which actually is also an asset. So everything's an asset in this transaction. If it says that they've purchased on credit or on account, then you need to look at a liability. So looking at the rules for assets, to increase an asset, it's a debit. So these two will be debits. To decrease an asset is a credit. So this will be a credit. And remember, write the debit first. We have 2 debits, so I put the next one underneath. And then followed by the credit. How much did they pay? I'll add that up. 9,000 plus 1,000, we've got 10,000. Circle Films receives a 1,500 payment immediately after filming a customer's wedding. So first of all, receiving 1,500 means they're receiving cash. So that's cash increasing. And it says they've been filming a customer's wedding. That means they've been giving their customer a service. They've earned the revenue. So revenue is increasing. And we know cash is an asset. Let's take a look at the rules. Asset, increase, is a debit. And we've got revenue. Revenue is over here. Revenue increase is a credit. So notice there's always going to be one debit and one credit. Always write the debit first. Receives $2,000 to film a wedding anniversary in a few weeks' time. So again, we've got receiving cash, so we've got cash increasing. Now, have we given the service to the customer? No, because it says we're going to film it in the future, in a few weeks' time. So we've received the money from the customer, but we have not given the service yet. That means we owe a service to a customer. And from our definitions, we know when the business owes something, that's a liability increasing. And we're going to call this liability unearned revenue. So let's work out our debits and credits. Cash is an asset increasing is a debit. Increasing a liability is always a credit. Please put the debit first. And the liability here is called unearned revenue. Unearned revenue is a liability, and it's increased when the business receives money, but they haven't given the service yet. They owe the service to the customer. Circle Films paid $250 in cash to run an ad in the local paper. So again, I've got cash, and paid means cash is decreasing. An ad is advertising. Advertising is a kind of expense for the business. And every time you have an expense, your total expenses are increasing. Let's work out the debit and credit. Cash is an asset decreasing is a credit. Advertising is an expense, and expense increasing is a debit. All expenses should be listed separately in their own T account. So I'm going to specifically write that this is advertising expenses, not just expenses. Why? If you own a business, you want to know all the different types of expenses you have, not just what the total expenses are. Circle films a dance competition, leaving a $3,500 invoice with the customer. First of all, films a dance competition. That means they've given the service to the customer, they've earned the revenue. Whenever you earn revenue, you need to think about, have we got the money already? Did we just get the money, or are we waiting for the money? Now here it says we're leaving an invoice with the customer. An invoice is simply a letter showing how much money the customer has to pay. So that means that the customer has not given us the money yet. We're still waiting for the money. That's going to be increasing accounts receivable, and accounts receivable is a kind of asset. Again, how do I know that that's accounts receivable? You just need to practice, and then you'll get familiar with all these different terms. So accounts receivable is an asset. An asset increasing is a debit. Increasing revenue is here. Increasing is a credit. Always put the debit first. Number 7, we've purchased another video camera. So that's going to be increasing our asset equipment. This time we didn't pay for it. It says we've signed a 9-month promissory note. So we owe the money. That's increasing our liabilities. Equipment is an asset, so that will be a debit. And increasing a liability is going to be a credit. Write the debit first, followed by the credit. That's $9,000. You might be wondering about the interest. Do I have to record interest at the moment? The answer is no. At the moment, we don't actually owe any interest. We owe $9,000 on the note payable. The interest expense will occur as the time goes past. So we will have to probably make an adjusting entry to record that interest. We received $3,500 from a customer in payment of the invoice from transaction 6. In transaction 6, we earned the revenue and we recorded accounts receivable. Now we're getting the cash from that customer. So that's cash increasing. I'm not going to record revenue here, even though the cash is from the customer, because I already recorded the revenue when I recorded the transaction number 6. What I am going to do is decrease the accounts receivable. Because I've received the cash now, I'm not still waiting for that money. Both of these are assets. The increase will be debit, the decrease will be credit. Write the debit first. We pay wages. You pay with cash. Wages is an expense. Every time you pay wages, your total expense is increasing. Cash is an asset. Expenses increasing, always debit. So write the expense first, and don't just write expenses. We need to write what kind of expense it is. So we pay its owner a cash dividend. Again, cash is decreasing, paying, and the dividend is increasing. Cash is an asset and a decrease is a credit. And here is dividend.